decreasing term life insurance. And the reason why this particular topic is incredibly important is because, believe it or not, there is still a market for decreasing term life insurance. However, not many carriers offer it anymore, but it's still important to know what it is and when it's used for, when it should be a consideration for one of your clients. So what exactly is decreasing term? That's what we're going to talk about first. Okay. So decreasing term is it's an annual renewable term, and it's either renewed, or I should say it's a renewable term, and it can either be renewed annually or monthly. And it's a type of renewable term where the death benefit decreases over time. So I know that we're accustomed to seeing the typical annual renewable term. I even have a segment within our course that talks about annual renewable term, but we're accustomed to seeing it as an increasing death or increasing in premium, should say, but the death benefit is level. This is a different type of renewable term where the death benefit itself decreases over time. So let's talk a little bit about why would this even be a consideration for someone, right? It really is intended to protect the beneficiary, right? It's intended to protect loved ones from the burden of taking on any form of a large debt. And typically you're going to see these large debts in the form of a mortgage, a student loan, and personal loan, right? And it can also be used as a strategy if the insured, so if one of your clients is working toward becoming self-insured. You'll see this strategy used a lot by let's call them the buy term, invest the difference crew, right? Where their primary focus is buying term to traditionally, potentially in the later years, using a decreasing term strategy as the client becomes self-insured. So again, it's intended for the purpose of taking care of large debts that would otherwise be transferred to the beneficiary of the insured, or it would be used in a case where the client is looking to, or their strategy is becoming self-insured, and therefore in the later years of their life will no longer need a life insurance policy. So let's talk a little bit about I talked about the purpose of decreasing term, but let's talk a little bit about how it actually works, right? So let's talk about coverage. The coverage is set for a specific period of time, just like a traditional term life insurance policy. You can take it out for, 20, 30 years. And let's just say in this particular case, it's to cover a mortgage or a loan term. If the mortgage or loan term is 20 years, for example, the client would apply for a 20-year decreasing term life insurance policy. The decreasing term policy, however, is not typically going to be renewable for a new term period, nor is it convertible to a permanent life insurance plan, for example. Once the coverage term ends, the policy terminates, and the client will need to apply for a new policy if coverage is still needed. Now, just important to note that approval is still going to be subject to medical underwriting, and it is based on new age. And because it is going to undergo medical underwriting, they do still have to qualify for a plan. Now, the death benefit in this particular case, just like it's in the name, right? Decreasing term. The death benefit decreases over time. Usually it's going to be in line with a mortgage or loan balance. The beneficiary can actually be the loan company, it can be an individual, or it can be a combination of both. And those terms need to be specified within the life insurance policy contract. Now, the decreasing benefit coverage schedule is determined based on the specific terms of the policy, and it does vary by carrier. So it's important to note that and understand what those terms are with each carrier. So for example, say the decreasing rate is 4% each year and the mortgage is $500,000. So they take out let's say a 30-year decreasing term policy. The decrease at the beginning of year 2 of the mortgage would be $20,000. However, so basically 4% times 500,000, which is the mortgage. In year 2, the death benefit decreases down to 480,000. This is just an example. So it decreases by 20,000. However, if the interest rate of the mortgage or loan is higher, the client is risking not having enough coverage in the later years to cover the mortgage upon death. Okay. So the loan rate itself does not at all align with the rate of the decreasing death benefit schedule and vice versa, meaning the client is not going to take out a decreasing term life insurance policy. And let's say their mortgage rate is 6%. Their loan rate is 6%. And let's say that the decreasing rate of the term is 4%, right? But essentially they're paying more in interest, which means what that translates to is that they'll end up owing more on the mortgage than what the mortgage or what the decreasing term policy is going to pay out to the beneficiary to then pay the mortgage off. So I hope that makes some sense. And then when it comes to the premiums itself, the premiums are often going to be lower than level term. So level term means that your premium stays the same and your death benefit stays the same throughout the entire life of the term contract, the term policy. With a decreasing term policy, the premiums itself are usually going to be lower than a level term. But with some carriers, the premium payments remain the same. They remain level throughout the entire term. So for example, the client can end up, so let's just say the client is paying $150 a month for a $500,000 30-year term policy, decreasing term policy. If let's say in year 2, as mentioned in my previous example with the coverage decrease schedule, and let's say in year 2, that term policy is now valued at $480,000 death benefit, but they're still paying the $150 a month for that $480,000 in coverage. So even though their coverage decreased, their premium stays constant. It stays the same. Now, what that's called is level premium decreasing term. It is important to understand what type of decreasing term plan the carrier offers so you can accurately explain that to your potential client, because they do need to understand that, hey, in year 20, they might be paying $150 a month, but their coverage is now $50,000, right? Or $100,000, right? So that's what that essentially translates to. And then when it comes to refinancing, so refinancing a loan. So a lot of times people think that, well, if I refinance my loan, what happens to my decreasing term policy? They're not married. What that means is, even if a client refinances their loan or refinances their mortgage, that plays no role in their existing decreasing term policy. So it will require the agent or you to review that life insurance or the life insurance needs and determine if any adjustments can be made to their existing policy. In most cases, carriers do not allow for changes to be made on decreasing term policies. Once they're issued, and that's it. So if options are available to modify the existing policy, then obviously go for it. But most carriers do not allow that. A new term essentially will need to be applied for. And just as with anything else, it does require medical underwriting for approval.